From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for October 3rd, 2025. Looking at the calendar, your Milwaukee Brewers, with the best record in the league, host the Cubs for Game 1 of the playoffs tomorrow. And the Packers, well, they get the week off. The Milwaukee Lakefront Marathon, the city's biggest race, is back this weekend, and they'll even let you walk across the Hone Bridge. That's something I've always wanted to do. On Saturday, there's the Lehman Brewing Fish Boil in West Allis, featuring their Tequila Gordita smoked pumpkin beer. And the Baird Center will be buzzing with the 15th annual Milwaukee Tattoo Arts Festival all weekend. Okay, first up, the Ig Nobel Prize. You know, the award that celebrates scientific research first, makes you laugh, and then makes you think. It naturally attracts some unique theories. This year's honorees found two very important things about alcohol. First, a few drinks sometimes improves your ability to speak a foreign language. And second, it always impairs the ability of bats to fly. Who would have thought? Other critical studies included whether painting zebra stripes on a cow can reduce insect bites, and the earth-shattering question of what types of pizza lizards prefer to eat. Now, speaking of unique awards, this past week was Fat Bear Week. Yes, it's a real annual competition held in Alaska's Katmai National Park. And this year, after a truly grueling competition, the champion is a brown bear known only by his official designation, 32 Chunk. Chunk absolutely destroyed the competition, besting two-time champion 128 Grazer and, my favorite, runner-up Bear 856. Congrats, Chunk. May your belly be full and your hibernation be long. Finally, remember Jacob Chansley? You might know him as the QAnon shaman who stormed the U.S. Capitol on January 6th wearing his horned warrior outfit. Well, now he's suing the federal government and President Trump for $40 trillion. And as if that's not enough, he's also claiming to be the rightful president of the United States. Someone should really tell him his 15 minutes of fame is up. On the podcast today, we have Hoelzl and John Sandstrom, Mike Hoelzl, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Jason. A decent week overall for stocks. NASDAQ up 1.3% this week, closing at 22,781, despite a bit of a give back on Friday. The S&P, though, positive to close out the week, back at record levels, closing at 67.16 on Friday. That's up 1.1% for the week. And the Dow Jones Industrial Average closed the week at 46,758 after adding 239 points on Friday. That's up 1.1% for the week. For the year, NASDAQ up 18.6, the S&P up 15.1, and the Dow Jones Industrial Average up 11.1%. You know, John, be remiss if we didn't start this week with the government shutdown. You and I were joking before the podcast about how maybe it's a good day for us to take one off as well since the federal government's not working. But interesting that despite what has been some pretty significant uncertainty and headlines, I think, leading up to the shutdown that made it clear that it was unlikely a deal would get done, we've just seen record stock market highs in the wake of that shutdown, and it seems like the stock market has largely shook off any concerns about the shutdown.
Yeah, and one thing that we were talking about before is not necessarily the impact on the markets, but the impact on some of the data being available, and that could be more of a concern in the coming weeks. As of now, like you said, the market has shaken it off, and we have seen back-to-back days at the S&P at all-time highs. But if we do continue to see this shutdown for another couple weeks, there could be some of these economic indicators that we miss that could change that storyline a little bit.
And we've already missed some this week. Joel, just looking at the economic data sheet you provide to us each week, it feels like there's a number of empty boxes there that we're not normally used to seeing empty.
You know, Kyle, you wrote a piece for our website that's in our newsletter that goes out after the podcast, and you pointed out how the Fed has depended a lot on data. One of the reports that they rely on, and one of the things that they're focusing on lately, is employment data. And today was the day that the Bureau of Labor Statistics was supposed to release its big monthly indicator on employment and jobs, and they didn't do it. Apparently it's all ready. It's all put together and ready to go, but because the government's shut down and because BLS specifically doesn't have any employees working, they didn't put that report out. So that's going to be interesting because we've been relying on the Fed and what it's been doing with interest rates to look at the interest rate market and thus the stock market. And without that data, without the numbers that the Fed governors are looking at to make their decisions, it'll be interesting to see what happens.
And interesting to see what happens is probably an understatement. I think when we look at some of the higher profile data points that we're waiting on, especially from the Bureau of Labor Statistics, the BLS, I think a big one, Mike, is that CPI number that's set to come out here in a couple of weeks, the Consumer Price Index, which ultimately the October 15th report is going to drive a pretty important data point for a number of our clients.
Shutdowns don't happen very often, and sometimes, quite honestly, they can be a little meaningless to investors because they're so short. Other times, they go a little bit longer and they cause a little bit more pain. And this one here is going to be interesting because of, as you said, Kyle, what's coming out on 10/15, which is the COLA adjustment for Social Security, which a lot of clients, that is a big chunk of what they live on, right? And if that's up in the air, I know a lot of my clients and some of yours too, they really look forward to those numbers because it's going to help them next year. Like, what can I do next year, right? Can I take that trip? Can I give money to my kids or my grandkids or anything like that? And if they don't have those numbers, it kind of puts them in a bit of flux about what they're going to do and how they're going to live. And so it's going to be interesting to see if this lasts until then, what kind of pressure then comes on, quite honestly, both parties from retirees, because they are their constituents. And if they're like, hey, you guys got to get your act together so I can live, I'm curious to see kind of what happens if it goes that long.
And Kyle, even before that, we don't know because nobody is working at the Bureau of Labor Statistics except for the commissioner.
They don't have
apparently.
One guy there?
That's the one guy, yeah. But so they're not collecting the data that they need to collect to know these numbers, to know the prices for all these products that they follow. So the COLA is determined every year based on a subset of the Consumer Price Index. And what it does is it takes the average of the 3 months of July, August, and September, and compares those to how much they've gone up from a year ago. So a year ago when they did that, it went up 2.5%, and they said, okay, Social Security beneficiaries, that's what your benefits are going to go up next year is 2.5%. It's been estimated that that's going to be around 2.7% for next year, for 2026, but we don't know.
Someone can't leak that out, like a Marvel trailer or something like that? No.
Perhaps at least some of that data could be available that way. But again, I think we've got a lot of uncertainty driven by this shutdown. I'm impressed, actually, that the stock market has held up well through it. We haven't seen massive spikes in volatility. The other thing that's been interesting, though, is that sometimes in prior periods of either government shutdown or at least budget negotiations, you see some spikes in interest rates as investors in U.S. debt start to get a little concerned about the government's ability to repay that debt. We haven't seen that this time around. In fact, rates moved a little bit lower this week. And so I think investors so far have taken this in stride. I think the longer it carries on, the more it's going to hang over the heads of, well, okay, those seniors, the Federal Reserve, and their ability to make solid decisions. And so I think important that we get some resolution, but it is, at least for now, something that hasn't been a big issue for investors.
The bond rate piece was, quite honestly, the most surprising thing for me this week about how it went lower. Normally you see the government shut down, you see at least some panic. I mean, panic might be the wrong word, but and bond rates tend to go up at least a little bit. To see it go down, I thought was really surprising, given kind of there doesn't seem to be any good news on the horizon in terms of when the shutdown will end.
And I think the reminder here that we are regularly surprised, not just by the headlines themselves, but sometimes by the market response to headlines. And so we could see that end long before we expect it. And even if we don't see that end, we may see stocks, as they have so far at least, continue to be fairly strong in the face of that uncertainty. You know, the article that caught my attention probably more than anything this week was the continued reminders of how much perhaps this AI frenzy looks like a tech bubble. Going back now 25 years, John, you and I were kind of batting this around, but in a lot of ways, it feels very different this time for kind of the tech sector and AI specifically than maybe what we dealt with going back those 25 or so years.
Yeah, my favorite part about this conversation specifically is it's speculation, right? So every day I seem to see 2 or 3 different articles on the AI, bubble. One of them is saying it's not a bubble for these specific reasons, and then the next one is saying it is a bubble for these specific reasons, each one with compelling data and economic factors to back it up, right? They both can't be right at the same time, but that's why typically we see bubbles looked at and studied after the fact, because then you can actually identify it being a bubble.
And Mike, one of the things that really stood out to me was in kind of surveying the current landscape, there are a lot of really strong businesses that are kind of at the core of this AI conversation. But at the same time, the conversation has, I think, just like it did in the prior tech bubble, it's boosted the returns of a lot of businesses that maybe don't belong in that same conversation for one very important reason.
Because they're AI adjacent?
Sure.
Is that I think a phrase I'm trying to coin? It's funny how much the AI conversation, just AI in general, has spread to all sectors of the market. Normally when you talk about AI companies, people just think of it as it's kind of boxed into the tech sector, right? Which then is in the growth sector. But no, it's stretched to all different types of sectors. Like, how are banks going to use AI, and what AI companies are they going to use to implement them? And that's just one example of how the AI bubble, frothiness, whatever phrase you want to use, pick something fun that you like, is just spreading and basically engulfing the entire market in ways that I don't think a lot of people necessarily initially thought it would.
No, I think that's fair, and it's a strong reminder for all investors that when you are making investment decisions, it's one thing to have optimism about a particular technology or a particular trend. It's another to have a fundamental thesis on why you should own a particular business related to it. And there's a lot of businesses out there that just don't make any money, even though they are in a particular space that might be attractive. And it's one of my favorite sayings to clients when they're asking those kinds of questions is that you can have a great idea, you can identify a great business, and it can still be a terrible investment for a lot of reasons, either because they don't know how to make money or because you can't buy it at a relatively reasonable price. And all of those things can work against you as an investor, even when the idea itself is brilliant or even when the business looks brilliant, just simply because, well, from an investment perspective, it's just not a great deal.
You put some kind of good examples out there. Before the podcast, we were talking about of what you like to call the zero revenue stocks. And it just made me think, like, one of them you put was like electric vehicles, like the vertical takeoff. And I mean, to me, that it just feels very much like FOMO investing. Like, you maybe missed out on NVIDIA. I don't want to miss out on that. I was a huge fan of Back to the Future 2, and we were supposed to have flying cars 10 years ago, and now we don't. But, oh, my God, now we might have it. I want to get in on it. This looks amazing. But then, as you said, they're not making any money. They have these massive valuations, but it looks cool. And so I want to invest in it. But, yeah, that can really come back to bite you if you don't really, like you said, have a strong kind of grounded thesis in what you're investing in.
Yeah, the electric vertical takeoff and landing vehicles, I think just the next iteration of what has always been just a few short years away, which is that flying car. And perhaps Doc's DeLorean is the perfect example
I mean, it was
that I
so
think we'd
cool.
all love to
It was so
to be able
cool.
to pilot. Joel, we did get a little bit of economic data this week that at least either got out before the shutdown or maybe wasn't directly tied. One of the big ones seemed to be some of the housing sales data.
Yeah, there was that. But before I get to that, let's get back to jobs, because we didn't get the jobs report today, but we had some glimpses from other reports that came out this week. One was one of the last reports from the BLS before the shutdown, and that was on job openings and labor turnover. And this is for the month of August, so we would have been seeing numbers for September today. But one of the things that I look at with the job openings is comparing the number of job openings and considering those as sort of the demand for workers, and then comparing them with the number of unemployed, the people who are out of work and actively looking for work. And for the first time since April of 2021, so in more than 4 years, for the first time, there were fewer job openings than there were job seekers. So, you can't put a whole lot into 1 month, but it's something to keep an eye on. And it further confirms what we were seeing before about a weakening job market, that not necessarily a bad job market yet, but it's getting weaker.
Well, it just kind of continues the trend that we've seen since the start of the year of just jobs in general, just little by little each month going down, and quits little by little coming up. It's become almost a trend that you can't ignore right now. But what does it say over kind of the broader markets? But I do find it interesting that, like you said, for the first time in over 4 years, that equation is not in the job seeker's favor, which I think is a pretty big deal.
Right, yeah, and it's a trend, and we saw trends on, so we're, as long as the government's down, we're going to rely more on private reports. So we had the Institute for Supply Management come out with their manufacturing index and their services index. Services index, the employment aspect of that has been down for 4 straight months. It's been contracting, and in manufacturing, it's been contracting for 8 straight months. So between some of the private stuff and some of the public stuff, we're seeing those numbers continuing, those trends continuing. And back to your housing question, we had numbers on home sales pending from the National Association of Realtors. That was stronger for the month of August, but it's still weaker overall. We also had numbers from, do I have to say the whole name? The S&P, CareTotal,
CoreLogic, Case-Shiller.
Yeah, they changed the CoreLogic part of it too.
AutoZone.
Yeah, exactly. Yeah.
Presented
It's
by
like
Visa.
It's like we're naming a stadium or something. but they're showing that the year-to-year change in prices is actually getting very thin, and it's the lowest, one of the weakest readings that they've had in a decade. So they're seeing that the demand for housing is actually tapering off, and that's going to be interesting to watch too, because housing's a really crucial part of the economy.
It is key. Household formation drives so much of consumer spending, and if you don't have that formation, if you don't have turnover in the housing market, you potentially show some weakness then in the consumer spending piece, which, as we often quote here, is just such a meaningful portion of the overall economy. As we look at some maybe changes coming to the investment landscape, Mike, one of the ones that one of our colleagues pointed out this week, a potential shift in how investors may pursue kind of broad baskets of investments. We often talk about kind of the mutual fund wrapper as this way to buy 50, 100, multiple hundreds of stocks or bonds, or some version of a basket that gives you the ability to diversify in one clean wrapper. And so for years, that was kind of the preferred method. Often it was the only method to get that kind of exposure. We're now seeing some changes coming through the SEC that potentially may give investors in mutual funds an opportunity to pursue something that might be a little more tax efficient going forward.
The ETF kind of, we'll say, revolution that has kind of overtaken investing is probably one of the biggest things to come into this space in, decades, perhaps? And the fact that now with ETFs exchange-traded funds, for those who don't know, but I'm assuming if you're listening to this, you know. Because of their tax efficiency, because they don't really dole out capital gain distributions, the fact that one fund company now is applying to be able to basically, you can switch over your mutual funds to the corresponding ETF in that same fund company, that can save clients, thousands of dollars on capital gain distributions that will help them out in a tax efficient manner while still giving them that access to that broad range of individual stocks. And it's not necessarily going to be a taxable event, which is huge for a lot of clients. I can't tell you how many times on the phone we talk about taxes. I'm sure you guys do as well. But the fact that you can still get that same kind of broad range of investing, but now you don't have these giant capital gain distributions, you will still have the gains on the funds, but that's not necessarily the end of the world. You might be a little bit more willing to chop down a bigger fund or sell a little bit because you're not getting that capital gain distribution anyway at the end of the year.
Yeah, for investors, it's about control, right? And the challenge with those mutual fund structures was that when they sold something within the portfolio at a gain, they passed those gains along to the shareholders. And the ETF structure being a little more tax efficient in the way it goes about that, it gives the investor control back over when they take those gains. And so you're still going to have them if you're making money in an ETF, the same way if you're making money in a mutual fund. It's just that instead of taking those gains year by year as they come, you can defer it, and you can pick and choose now, when do I want to get hit with that tax bill? Am I in a more favorable tax rate? Can I pass this to a more favorable place? And so I think for investors, again, it really is about control. And at the end of the day, if I can get the same piece of candy but in a little bit more attractive wrapper, and it costs the same and it's doing all the same stuff, I think I'd rather have the slightly more attractive wrapper. And in this case, it's simply just that tax efficiency piece. Joel, we have a newsletter coming out this afternoon. We've got a seminar on tap for next week. Plenty of kind of client communication out there. Anything big that stood out to you from this month's newsletter?
No, not really.
Oh, good. Excellent. Well, we enjoy doing the program.
We always have stuff going on. Yeah, actually, Kendall Bauer started a series that we just started posting this week on, it's called Letters to a Young Investor. And, people who tune into the podcast know what ETF stands for, but a lot of people don't. And this is sort of aimed at the newcomer investors of people who are 20-somethings and, maybe they just got out of college and they're getting their first professional jobs or their first post-college work, and they have a little money to set aside, or should, and Kendall's writing a series to sort of address them, one topic at a time, talking about fundamentals, basics of investing, and including tips of how to apply those principles.
I think so important, and we have so many conversations with mom and dad or grandma and grandpa of the target audience for these letters who say, how can I help my grandchild understand how I got to where I am? How can I help them to understand how important it is to start early, to make sure you're investing and not just saving? And I think Kendall's articles and what we've seen so far of kind of what he's hoping to put together in these letters really are going to hit home that point. And I think a good resource for our listeners especially to say, hey, here's something I want one of my family members to know that maybe resonated with me when I was younger, but maybe I'm not necessarily seeing it resonate the same way. I think this will be a good way to try to communicate that. Well, with that, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.